Thank you, everyone. Appreciate the opportunity to introduce AQR and discuss and educate you a little bit about managed futures and what that is. Have an agenda here. Today, spend minimal time talking about AQR and more on what managed futures is, and then we'll discuss some of the performance over mainly the last year, which has been quite an interesting environment, especially leading up post-August. Especially with the equity volatility that we've seen. So just to sort of set the stage, and what is managed futures, and I'm going to describe it in a little more detail here. Managed futures is a strategy that's been pursued by hedge funds since at least the 70s. It's a strategy that has historically achieved strong performance in both up and down markets. But these strategies, since these strategies have existed for years, a lot of investors have shied away from them, perhaps due to a lack of understanding in how they work. They've been traditionally in hedge fund form. They've been predominantly run by quantitative investment managers. They've been mysteriously black box type strategies up until now. And we like to sort of unveil sort of the underpinnings of the strategy and illustrate they are quite simple strategies and well-researched strategies that have been around for a long time and can provide great diversification benefits to your portfolio. So with that, a little bit into our firm. So AQR was founded in 1998 by 4 individuals that all met at Goldman Sachs. They were running quantitative investment strategies at Goldman, and then had the opportunity to spin off on their own and form AQR. They started as a single strategy hedge fund back then, and then have since morphed into a very diversified global asset manager. We run $136 billion in total assets. We've got over 550 employees. We are allocated between traditional equities and also call it alternative strategies. You can see a breakdown of the assets on the left from traditional equities to alternatives, and then in the right pie chart, we take a look at a more granular view of the alternative assets, managed futures being a large part of that asset base. At AQR, we pride ourselves on having very close ties to academia. Several of my colleagues are current and former professors of finance at some of the largest institutions around the world. We are actively, or we have been, huge publishers of research, and we are still actively publishing research, not only for our own use within our investment strategies, but also for the general public and for academics alike. Page 7, or Exhibit 7, is just a small example of some of the research we've published over the years, and this is mainly focused on just managed futures or trend-following type research. So a lot of our research can be found on our website at aqr.com, but we take a very research-driven approach to all investment strategies, and are still actively pursuing a lot of research and trying to enhance our process and provide additional information to outside investors. So managed futures. So managed futures, as I described a little earlier, is a strategy that invests in a diversified set of liquid futures and forward contracts. Futures and forwards are merely the securities we use to implement a trend-following strategy. So instead of focusing on the futures component that's in the name, think of the futures as indexes. And the futures contracts are the most liquid way for us to invest in a diversified set of indices. The strategy can go both long and short. Trend following is a strategy that is buying assets that are rising and selling assets that are declining. And it has historically exhibited a low average correlation to traditional markets. This is a key feature to the strategy and why it's often recommended as a complement to a traditional stock and bond portfolio, as well as a complement to traditional alternative portfolios as well. This exhibit shows you the 100+ markets we trade, which is globally diversified and equal weighted in our approach. Since trends exist across almost all assets, it is best to diversify as broadly as possible, reducing your reliance on a smaller set of markets. Now, some trend followers tend to focus on certain asset classes more than others. We take a very diversified approach, and since trends exist across all these different markets, why not be as diversified as possible? Let's talk a little bit about how trends are formed. So what is a trend? A trend is the movement of an asset or security in either a positive or negative direction. Research has led us to believe that investor behavior is the main driver behind why markets trend. Below is the stylized life cycle of a trend. You'll see an initial underreaction to a shift in fundamental value can potentially allow a managed future strategy to invest before the information is fully reflected in asset prices. The underreaction phenomenon can be explained by a couple theories, one being anchoring, which well-known behavioral economist Daniel Kahneman published some research on a couple decades ago. And this is when people anchor their views to historical data and adjust their views insufficiently to new information. Also, there's the disposition effect theory, which a couple of my colleagues have published some research on as well. This is simply investors tend to sell their winners too early, banking their gains, and ride losers too long, hoping for a comeback. This phenomenon creates frictions that cause price pressure, therefore extending the time it takes for assets to realize their true fundamental value. On the overextended part of the trend, as time moved on, this can be explained by confirmation bias and herding, also known as bandwagon effect, or I personally like to call either the golf course chatter or cocktail party chatter. You hear a lot about a hot stock or tip that's been working for others, so you make an investment decision based on that. You therefore are contributing to a price trend and perhaps making it extend beyond the true fundamental value that that stock or security or market should be trading at. So now we've established what a trend is, we have to identify the trend. And how do we identify these trends? So to determine the direction of a trend, we look at solely the price of the asset or security over multiple time horizons. Those time horizons are split up into short-term and long-term horizons. Short-term, for example, would be 1 to 3 month range, and a long-term would be about 12 months. We look to see what that contract or the price of that contract or the price of that market has done over those different horizons and aggregate them into one ultimate position. For example, if we were to pick on gold, and this is by no means how we are positioned today, and this might be a little stale, but just an example, we would look at gold's price today versus a month ago. So that's a 1 month horizon we're taking a look at. This can simply be done by using any financial website or even in the newspaper, just doing comparison where gold is today versus where it was a month ago. Let's say if the price of gold has gone up over the last month, that would be a buy signal for the 1 month signal. Then we repeat that process for a 3 month horizon. And if we see the price of gold has gone up over the last 3 months, we would add a further long signal to that. Then we would look at the last 12 months. And in this case, we have a weak sell signal. So that means the price of gold has gone down over the last 12 months. We would net all those signals together and come up with an ultimate position, which would be a week long signal. You'll also notice an overextended signal, the orange bar or orange box at the bottom. This is more of a risk management feature trend followers incorporate to help reduce negative performance in a strategy you can experience during trend reversals. But in this case, it's calling for a weak buy. So as we aggregate those 3 signals, the resulting position is a medium buy. which in this case we would go long the gold futures contract based on the long-term, short-term, and overextended measurements. I just want to pause and see if there's any questions. This is where it gets a little confusing, but we're simply just looking at the price of an asset over different time horizons and aggregating whether they've gone up or gone down and resulting in an ultimate position. We do this across over 110 securities that we saw in a previous exhibit, and this goes on a daily basis and is very dynamic. And I'll show you an example, a real-life example in the S&P 500 in the next exhibit. There's certain market environments where a short-term signal can benefit versus a long-term signal. We look at research just focused on, say, a 1 or 3 month signal. A short-term signal has a lot of noise in it. We can see markets fluctuate very frequently. And you can get caught up in a lot of transaction costs, a lot of trading, a lot of rebalancing, resulting in a lot of additional costs just based on some short-term rebalancing based on those signals. So that's why we like to incorporate a long-term signal along with it. Long-term tends to smooth out a lot of that short-term noise, therefore making it a more consistent, longer-term investment process. Now, we're not short-term traders, we're long-term investors, but there's a lot of short-term noise in the marketplace that can cause a lot of unnecessary rebalancing. Therefore, we like to take a look at a longer-term view as well. This is where some of the different managed futures managers differ. Some will say we're more short-term based than long-term based, and at the end of the day, our research has really illustrated that you're better to be mid-term. You're better to be equally diversified across your signal types as well as asset classes that you're trading. No, the short-term signal is not more powerful than long-term signal over a long time period. So let's take a look at Exhibit 13. On this slide, we take a look at the process over a 2-year period surrounding the financial crisis. The equity market decline started in June 2007, which helped position both short-term and long-term trend signals short. So when the fall of 2008 came and the market bottomed, trend following strategies profited handsomely by being positioned short based on the trend. The tricky part of trend following is the point of reversal, which occurred in March 2009. Without the risk controls in place, such as overextended signals, it would have taken a trend following strategy more time to reposition the portfolio long, therefore giving back some of the gains reaped during that market decline. This is just an example of how the process works over time, not to mention one of the great commercials for trend following. However, the nice thing about trend following is that hedge during extreme market downturns, providing investors a strategy in their portfolio that may profit when traditional equities are struggling. We've seen this actually happen over the last month within August as the equity markets have declined. This year has given trend followers the opportunity to position short in a lot of the markets, not only commodities but also equities, and had very nice, attractive returns in the month of March, or month of August, which I'll talk about in a moment. Exhibit 14 is a correlation matrix. This is comparing managed future strategy to the main stock and bond indexes. The matrix, as you can see, is color-coded, with green being good, red being bad. You can see managed futures has low to zero correlation to the traditional assets, making it an excellent diversifying source of returns for your portfolio. So with any investment policy statement, you like to diversify your portfolio with different sources of return, with different assets that have low to negative correlation with each other. So when a certain asset's doing well, something else in your portfolio is probably doing poorly, and vice versa. So managed futures is able to deliver this diversifying source of return without having too much equity reliance or fixed income reliance. A lot of people have always focused on diversifying away from equity risk, but recently there's been a lot of talk about diversifying away from interest rate risk with potential of rising interest rates and bonds having a struggle going forward. This is another strategy that can actually profit during a rising interest rate environment. So it's just not hedging you against equity market downturns. It can also do well during bond market bear markets as well. The next exhibit, page 15, illustrates different allocations to managed futures in a general portfolio. Now, Biltmore Capital takes a far broader approach to diversification than we illustrate here, but the general idea is to show how adding managed futures to a portfolio can only be additive. In this case, the overall portfolio's volatility has gone down, as well as the magnitude of drawdowns, all while preserving an attractive rate of return. And again, this is achieved by the low correlation characteristics that managed futures has to both stocks and bonds. Exhibit 16 is another way of looking at how managed futures can complement a traditional portfolio. However, the big takeaway from this is how it performs during different equity market cycles. In this exhibit, we look at quarterly returns for stocks over the last 20+ years. We rank them into thirds: weak, normal, and strong environments. And what we find is that managed futures tends to do best when markets have a strong trend in either direction. They do well when stocks are weak, as well as when stocks are strong. In summary, I like to say trend following does well when things go from good to great or bad to worse. The normal periods are flat, but generally you have other areas in your portfolio working for you and generating positive returns. Yeah, great question. We've had that question a lot lately, and we've looked at a lot of research. As being a diversified manager, we'd love to be able to time these strategies, when to get in, when to get out, and we found no solid evidence that it's easy to time a trend following strategy. The power of the strategy is really in the strategic allocation to the strategy. Because as we know, it's really difficult to know when stocks are going to turn for the worse, or for that matter, bonds are going to turn for the worse. And having a strategic allocation to an alternative strategy provides you with that diversification at all points. So it doesn't risk you missing the entry point or missing the exit point. We think timing is a difficult thing to do, and we don't recommend it. Therefore, it should be a strategic part of your allocation. We've looked at it several ways, and there's just really no way to determine a good entry or exit point for managed futures. So to summarize the main points before I talk about performance, trend following it's an intuitive strategy with strong empirical evidence and economic foundation. The diversification benefits are powerful when added to a traditional portfolio by helping manage downside risk and keeping you invested throughout the market cycle, helping achieve your long-term investment goals. So I'll move to performance. We have a lot of figures here. I'm going to focus on just a couple exhibits, mainly the most recent end date, August 31st, on slide 20, which I'm pulling up right now. So to walk you through what's gone on in the managed futures space over the last 12 months, I think will give you a good idea of how the strategy is a very good complement to a traditional portfolio. About this time last year, going into the fourth quarter, we had very bullish trends in a couple markets, bearish trends in commodities, and the strategy was positioned appropriately to profit from it. Fourth quarter 2014 saw excellent returns in managed futures from predominantly being short commodities, long equities. That trend continued into 2015 for the first quarter, and again, it continued to profit well as a strategy, and then second quarter, almost on the dot when the second quarter began, there was a huge reversal. All of a sudden, equities started to sell off. Everything that was trending just completely reversed. And unfortunately, we saw second quarter performance go down significantly. And this is that reversal effect that managed futures strategies try to avoid, and really sort of gives the strategy some struggles. After being able to position over the last quarter, the third quarter continued that trend, and most of the managed futures or trend following strategies were positioned mainly short equities and then short commodities, and then positioned mainly on a couple different currency crosses. And when August hit and a lot of the volatility hit the market, managed futures tended to do very well. So we were up that month probably 8-9% in the portfolio after losing that amount in probably the second quarter. So the result at the end of August was a year-to-date performance of 3.2%, as you can see on this exhibit here. But it was somewhat of a roller coaster ride just based on how the year evolved, based on the different trends, and how a trend following strategy shifted its positions and then was able to profit during a lot of the market turmoil that we saw in August. But that's a really short-term picture. We don't like to focus on the short term, so we'll take a look in the subsequent exhibits here. Over the long term, we've realized about a little over 4% average annual return. That's within expectations. We're pleased with that. It is still the mutual fund that Biltmore invests in has only been live for 5 years, and those 5 years have not seen a full market cycle, in our opinion. So we're pleased with that. We've realized a volatility of about 8%. That's an 8% standard deviation. That's slightly lower than what we target. We say on average we're supposed to achieve about a 10% standard deviation. So we're pleased, and that results in a Sharpe ratio, which is a measurement of risk-adjusted return, of about 0.4, which again we're pleased with and is north of what the long-term Sharpe ratio is of equities, what the long-term Sharpe ratio is of bonds, and long-term Sharpe ratio is versus a 60-40 combination of stocks and bonds. So this alternative strategy is delivering on its promise, and we're quite pleased with just the 5 years of performance so far. I think the big section to highlight on this exhibit is really the middle section about the beta. Now, I was talking a lot about correlations, and there's some subtle differences between beta and correlation, but what we're trying to do is achieve also not only low to negative correlation, but also low to negative beta to certain other assets. And we've done that. We've achieved low beta to stocks, bonds, and also commodities. And again, illustrating that this is truly a diversifying source of return that's not tied to the stock market, bond market, or commodity market. And then the chart on the bottom is just a sampling of quarterly returns since the fund went live. And I wish we had updated it through third quarter, because it was a big positive third quarter, 2015. And you can see how we did in the second quarter. But look at the 3 preceding quarters there. And then the Exhibit 22 breaks down our performance over the different time horizons and over different assets. So we like to analyze what's going on in the portfolio versus the market conditions out there, and this is something we look at on a daily basis. And it goes back to a previous question, Brad, that you brought up, that do we like short-term versus long-term? Why do we invest in both? Well, right here, long-term trends over the last 5 years have been the major drivers of performance, but short-term trends have also contributed. We think if you had a longer sample set, maybe 10, 20 years, the returns would be about equal between long and short. So we don't want to limit ourselves to any one horizon. And then same bodes for the asset classes. I mentioned some trend followers focus on certain asset classes and omit others. We like to be equally allocated. And what's interesting here, over the 5 years, equities have not contributed anything to the portfolio. We've made most of our returns based on fixed income trends, or bond trends, currency trends, and commodity trends. So this is just to put some of the performance in perspective in the different market environments when we break it down based on trend horizons, and then how the strategy does versus within its asset classes as well. Any questions here?
John, no other questions at this point.
Okay. So that's pretty much it for the prepared remarks. I don't know if any other questions are going to come up, but again, AQR, we don't think this is a one-stop solution as an alternative source of return. We think it's part of a well-diversified portfolio, which it sounds like Biltmore utilizes it in that capacity. And there's a lot of evidence supporting a trend-following strategy. And we've brought it from a traditional hedge fund, very black box type strategy, into a more liquid, registered, low-fee friendly mutual fund, and have seen a lot of use out of traditional retail investors, and in addition to an increased use in institutional market as well.